Atlassian, ticker team, absolutely crushed its Q4 fiscal 2026 consensus across the board.
Right, no question about it.
Adjusted EPS came in at $1.87, which blows past the $1.50 consensus. And total revenue hit $1.766 billion. That's up 27.6% year over year, which handily beats the $1.66 billion estimate.
Yeah, and the guidance is just as strong. I mean, Q1 fiscal 2027 revenue is guided to a range of $1.705 to $1.715 billion, putting the midpoint nicely above the $1.67 billion estimate.
And full-year fiscal 2027 revenue growth is guided at roughly 13%, with subscription ARR expected to be up 18%.
Which the market obviously loved.
Loved is an understatement. The market aggressively repriced the stock on these numbers. We saw shares gap up roughly 35% from a pre-earnings close of $110.17 to intraday highs above $153.
Wow.
Yeah, we're settling around $149.
You know, that kind of immediate, violent upside repricing for a mature software company is pretty rare. It really tells you the market was positioned incredibly defensively going into this print. Everyone was just expecting the worst.
Right. And if you are holding Atlassian stock right now, you are probably thrilled with this 35% pop. But for this deep dive, we need to look under the hood to see what is actually driving that euphoria.
Exactly. We have to look past the headline numbers.
Right. So our mission today is to break down the specific segment performance, parse out some rather confusing margin guidance, and dissect management's massive commentary on artificial intelligence.
Which is a huge piece of this.
It is. Then, to keep things grounded, we're going to expose the hidden execution risks and the revenue deceleration baked into their outlook, focusing strictly on what retail investors need to understand about the mechanics of this business.
And understanding those mechanics is vital because this report is acting as a bellwether for the entire enterprise software sector. If Atlassian can navigate this environment, it signals a pathway for others.
So let's get right into the anatomy of that $1.766 billion in top-line revenue. The breakdown reveals a pretty fundamental shift in how they make money. Cloud revenue growth accelerated to 31% year over year, hitting $1.213 billion.
That's a massive acceleration.
It really is. Data center revenue rose 21.3% to $461.9 million, and marketplace and other revenues increased 20.1% to $91.1 million. The future-looking metrics tell a similar story. Total subscription annual recurring revenue, or ARR, ended the quarter at $6.606 billion.
Up 23%, right?
Exactly, up 23%.
But the metric that really stands out there is the remaining performance obligations, or RPO, which surged 44% year over year to $4.8 billion.
So RPO is essentially the backlog, right?
Yeah, exactly. It is contracted revenue that hasn't been recognized yet on the income statement. When your backlog is growing at 44% while current revenue is only growing at 27%, it signals deepening long-term financial commitments from large enterprise customers. They are locking in contracts extending well into the future.
I want to spend some time on the dynamic between the cloud revenue and that data center revenue because understanding that relationship is, frankly, the only way to understand Atlassian's current valuation.
Yeah, they are in the middle of a massive structural transition.
Right. To put it in perspective, imagine a high-end legacy physical gym that has decided to pivot entirely to a month-to-month app-based digital fitness model.
Okay, fantastic.
But before they shut down the physical gym in a few years, they offer existing members a chance to lock in a multi-year, upfront, paid-in-full contract to keep using the physical weights.
Oh, that's a great analogy.
So the gym gets a massive immediate influx of cash today, but they are guaranteeing a steep drop-off in that upfront cash tomorrow once the doors actually close.
That captures the financial mechanism perfectly. Atlassian has drawn a hard line in the sand.
Okay.
They announced an end-of-life deadline for their legacy data center offering in March 2029.
Right.
So that 21.3% jump in data center revenue we just saw is largely just an influx of upfront term license revenue. Massive enterprise customers are effectively buying that 5-year gym membership. They are locking in their final data center commitments today to delay migrating their infrastructure for as long as legally possible before that 2029 cliff.
Which artificially inflates the top-line revenue numbers right now. I mean, it creates a short-term windfall in the balance sheet that just isn't going to repeat.
It absolutely pulls revenue forward. But the reason Wall Street looked past that temporary data center spike and aggressively bid up the stock is the 31% acceleration in cloud revenue. That was the make-or-break metric.
Because it invalidates the primary bear thesis that has been hanging over the stock for 2 years.
Yes. For a long time, the prevailing fear was that forcing entrenched, slow-moving enterprise clients into the cloud would cause massive friction.
I mean, migrating a decade's worth of Jira tickets and custom IT workflows.
It's an incredibly complex, painful process. The bear case assumed that if a chief information officer has to endure the pain of a total migration anyway, they might use that opportunity to shop around and move their business to a competitor.
Make them start fresh somewhere else.
Exactly. But seeing cloud revenue accelerate at 31% proves that Atlassian is successfully migrating its installed base without heavy attrition. They are holding on to those lucrative accounts.
The stickiness of the product is very real. Now, pulling in all this upfront revenue from data center holdouts obviously looks fantastic on the top line, but top line growth is just a vanity metric if it doesn't eventually translate into operational cash.
Completely agree.
And when we look at their profitability, I am seeing a massive disconnect in how they are reporting their margins. We really need to clarify what is actually happening with their cash flow.
The profitability narrative requires a bit of decoding, definitely, because it really is a tale of two distinct metrics. On a generally accepted accounting principles basis, GAAP Atlassian achieved a positive operating margin of 12% in Q4.
Which is a massive operational swing compared to a negative 2% margin just a year ago.
It is. But then when you look at their non-GAAP operating margin, it hit an impressive 36%.
Wow. And the cash generation itself was a monster. Free cash flow came in at a robust $475 million for the quarter, which translates to a 27% free cash flow margin.
Generating a 27% free cash flow margin in a macro environment where IT budgets are under intense scrutiny is exactly what institutional investors are desperate to see. It proves that once Atlassian software is embedded in an organization, the business model just prints cash.
But here is where I need to push back and, inject some skepticism regarding management's outlook. If they just printed a phenomenal Q4 non-GAAP operating margin of 36%, why on earth is management guiding for a brutal contraction down to 25% for the full year in fiscal 2027?
It sounds terrible on paper.
An 11-point drop in operating margins sounds like a disaster. Why would a company intentionally kneecap its own profitability metrics?
Well, the answer lies in that 24-point gap between the 12% GAAP margin and the 36% non-GAAP margin. That chasm is almost entirely driven by one single line item stock-based compensation.
The classic Silicon Valley accounting maneuver. Pay your engineers in stock options so you don't have to spend your actual cash, which artificially boosts your non-GAAP margins.
That is the historical playbook, yes. Non-GAAP metrics conveniently exclude stock-based compensation, while GAAP includes it as a very real, tangible expense.
So what's changing?
What management is initiating for fiscal 2027 is a deliberate structural shift in their compensation philosophy. They are intentionally trading equity for cash.
Wait, really?
Yeah, they are going to start paying their employees more in actual cash salaries and bonuses and less in company stock options.
Okay, so because cash compensation is treated as an operating expense in both GAAP and non-GAAP accounting, paying out more actual cash is going to drag down that non-GAAP operating margin in the short term. That explains the guidance dropping to 25%.
You have the mechanics down exactly. It hurts the optical margins. However, if you are a retail investor holding shares of Atlassian, this is arguably the most bullish fundamental development in the entire earnings report.
Because it finally puts a lid on shareholder dilution.
Handing out less stock means fewer new shares are being minted every quarter. When a company relies heavily on stock-based compensation, your slice of the ownership pie is just constantly shrinking.
Right.
By taking the near-term hit to their non-GAAP margins and using their massive free cash flow to pay employees in cash, management is structurally protecting the value of existing shares. It is a massive sign of corporate maturity.
They are acting like a grown-up business rather than a hyper-growth startup diluting its equity to infinity. So they have the top-line growth, they are generating immense free cash flow, and they are restructuring their pay to protect shareholders.
Checking all the boxes.
The logical next question is, where are they deploying all this capital to drive the next wave of growth? And based on the earnings call, the answer is an aggressive push upmarket into the enterprise space, fueled almost entirely by their new AI rollout.
The momentum in the enterprise segment is staggering. They ended the quarter with 57,334 customers generating over $10,000 in cloud ARR. But the real story is at the absolute top of the food chain. They highlighted record deal counts at the $1 million, $3 million, and $5 million annual contract levels.
The cohort of customers spending over $5 million annually grew an astonishing 70% year over year. I mean, think about the budget approval required to greenlight a $5 million software spend right now.
It's immense. And their net revenue retention is sitting strong above 120%, which means the customers they already have are consistently expanding their spend by at least 20% every single year.
That level of expansion implies the software isn't just a utility anymore. It is becoming the central nervous system for these organizations. And that brings us to the artificial intelligence integration, which really seems to be the catalyst for the 35% stock pop.
Yeah, this is where we have to confront a massive shift in market psychology.
Right, because before this earnings report, if you talk to SaaS investors, there was genuine terror surrounding artificial intelligence. There was this prevailing moat destroyer theory.
Absolutely.
The logic was simple. If generative AI can write code, fix bugs, and manage project timelines, an enterprise isn't going to need to buy a Jira seat for 50 different developers. They might only need 10. AI was supposed to destroy per-seat software licensing, but Atlassian's numbers suggest AI is actually a moat deepener.
We are witnessing a fundamental recalibration of that fear in real time. Atlassian has introduced Rovo, their proprietary AI agent, and it is already being used by over 80% of the Fortune 500. Furthermore, Rovo-assisted actions grew 50% quarter over quarter.
Wow. And they've also rolled out AI-native Jira upgrades that orchestrate external tools like Claude Code, Cursor, and GitHub Copilot directly within their platform at no extra cost for paid users.
Right. The report also noted that agentic automations in Jira Service Management tripled in just 6 months.
And for anyone not elbow deep in AI development, an agentic automation isn't just a chatbot that answers a question. An agent can actually take independent action.
Right, it does the work.
Yeah. If an employee submits an IT ticket saying their laptop is broken, the AI agent doesn't just reply with a troubleshooting article. It can automatically route a request to procurement, update the inventory database, and message the employee with a shipping tracking number.
And the reason Atlassian can execute those complex automations so effectively brings us back to why their AI is a moat deepener. It comes down to a concept management calls the teamwork graph.
I want to spend a minute on the teamwork graph because this explains the actual competitive advantage here. Raw AI models, whether it's OpenAI's ChatGPT or Anthropic's Claude, are rapidly becoming commodities. Every company on Earth has access to the exact same underlying models.
So simply having AI is not a moat.
Exactly.
The moat is the context you feed into that commodity model. Atlassian possesses 25 years of proprietary customer workflow data. Every bug fix, every delayed product launch, every internal communication protocol, it all lives inside Jira and Confluence.
It's all already there.
Right. When Atlassian layers an AI agent over that specific, highly contextualized data graph, the output is vastly superior to a generic AI tool.
The data in the report backs that up perfectly. Atlassian noted their AI agents are 44% more accurate while consuming 48% fewer tokens. And again, just to demystify the jargon for a second, a token is basically a piece of a word that the AI has to process.
Right, how they measure processing.
The more tokens an AI consumes to understand a problem, the more expensive it is for the software company in raw computing power.
But because Atlassian already has the company's entire structural context mapped out in the teamwork graph, their AI doesn't require a massive bloated prompt to understand the environment. It doesn't need to be told how the engineering department interacts with marketing. It just already knows.
Which is brilliant.
It is. This drastically reduces token consumption, lowering Atlassian's compute costs while delivering a more accurate result.
That context advantage is massive, and it explains why enterprises are expanding their Atlassian spend by 70% at the top end. But as with any deep dive, we have to pull back from the post-earnings euphoria.
Yeah, we have to look at the other side.
Because when you look at the actual fiscal 2027 guidance, this 35% stock pop seems to be ignoring some very sobering realities. The guidance clearly shows a notable deceleration in the business.
The execution risk moving forward is severe, and it is entirely embedded in that deceleration. Despite the Q4 blowout, full-year fiscal 2027 total revenue growth is guided to slow down to roughly 13%.
For context, they grew revenue at 26% in fiscal 2026. So they are guiding for top-line growth to essentially get cut in half. And subscription ARR growth is expected to moderate to around 18%.
That slowdown is the direct consequence of the data center cliff we discussed earlier. The influx of upfront term license cash is going to run dry. Management projects the data center segment will decline 4% in Q1 and then take a steep 17% plunge for the full fiscal year 2027.
The gym is finally closing its doors and the upfront cash stops flowing. We also have to point out that despite a highly profitable Q4, Atlassian still posted a full-year GAAP net loss of $54 million.
Right. Quarterly profitability is great, but over a full 12-month period, GAAP profitability is still escaping them.
Which puts the current valuation under a microscope. When a stock jumps 35% in a single day while simultaneously guiding for revenue growth to have, the multiple expansion is astronomical. They are currently operating with a deeply negative PE ratio on a trailing basis.
Add to that, we saw some notable insiders selling recently. CFO James Chung sold 8,838 shares, netting roughly $775,000. And CRO Brian Duffy sold 3,000 shares for about $269,000.
Now, the SEC filings do state these sales were primarily to cover tax withholding obligations related to the vesting of equity awards, which is pretty standard corporate practice.
Very standard, yes.
But when growth is decelerating and insiders are liquidating at these newly elevated levels, it is a data point you have to track.
Absolutely. If you synthesize all these headwinds, the overarching risk for anyone buying the stock today is that the market is pricing in absolute perfection. Atlassian is walking a very thin tightrope.
Yeah, they really are.
They need their cloud revenue growth and their new AI monetization to perfectly offset the accelerating 17% decline in the legacy data center business.
If the enterprise adoption of those Rovo AI agents hits a speed bump, or if migrating those final data center holdouts proves harder than expected, total revenue growth could easily dip below that 13% guidance.
And at these valuation multiples, there is absolutely zero room for error. The stock could get punished just as violently as it popped.
The transition has to be flawless. The legacy business is winding down, and the AI-driven cloud business has to seamlessly carry the full weight of the company's valuation.
Which brings us back to why this report is the bellwether for the entire software industry.
Exactly. Atlassian proved, at least for this quarter, that proprietary data context is the ultimate defense against AI commoditization. They proved AI isn't an immediate death sentence for seat-based software models.
But the long-term implications are still incredibly murky.
And that leaves you with a really provocative macro question to ponder as we look at the next 5 years of enterprise software. If these AI tools embedded in Jira and Confluence genuinely make developers 50% more efficient, what happens next?
Right.
Will enterprise chief financial officers use those massive productivity gains to buy more Atlassian seats so they can launch new projects faster and take market share? Or when the dust settles, will they eventually realize they can achieve their current output with 50% fewer developers?
Fundamentally breaking Atlassian's per-seat pricing model in the long run.
Exactly.
That is the ultimate tension of the AI era. Does unprecedented efficiency drive scale, or does it inevitably drive contraction?
It is the single most important question every SaaS investor needs to be asking right now. Follow the show for daily earnings coverage,